Hello everybody, it's me here, Cameron. Welcome to a new series I'm going to be starting here on this channel where I'm going to be buying and selling stocks for profit. Okay, now I want to start off by saying very clearly this is not financial advice and I am not claiming to be a financial expert whatsoever. Okay, the way I'm going to do these videos is going to be like a recap video of what I've done and why I've done it. Something I've noticed with the stock market, very simply, is good companies vary a lot in price. And the point of my strategy, very simply, is to find solid companies, and trade when the price moves. That's literally it. And I use the word trade very loosely because I'm not going to be buying in and out on a short-term basis. Like, I'm not buying stocks looking to sell them later in the day. They are plays where I'm looking at maybe a month, 2 months, whatever it may be. But let's start off going through the 5 stocks I have chosen. So I'm using Trading212, which I believe is the best platform in this country by far for trading in stocks. You have different types of accounts on Trading212, like with other brokers. But with 212, you can have an ISA account. And an ISA account lets you deposit 20 grand a year, up to 20 grand a year, and all the gains you made will be exempt from tax. The only tax you pay on American stocks is withholding tax, which is 15%, and that is on dividends. A lot of the companies I'm going to be buying into will pay dividends because I'm looking for pretty secure companies that have had a good financial standings. Those companies typically do pay dividends, but I'm not going to complain about getting a dividend payment. So that's the reason why I'm using an ISA, is because I don't pay tax on the actual higher selling price. If you buy stock at 100, it sells at 120, you make a 20% profit, you won't pay any tax on that because it's part of an ISA. I'm going to stay away from UK stocks because if you buy UK stocks, you pay stamp duty, which is actually much more expensive than the only fee you pay for American stocks, which is the currency conversion fee, which is FX, which is the cheapest on Trading212. Like, genuinely, 212 is the best platform there is out there. This isn't sponsored, obviously, and I'm not even going to do an affiliate link. It pisses me off so much when you see people making videos about stocks, about trading, about investing, and you look at their portfolio and it's full of these shit stocks with like £3 in them. It completely creates an unrealistic situation that no one's going to find themselves in, where they're referring hundreds of people. So they're trying to act like, oh yeah, my portfolio is just like what yours could be, but then it's full of these free stocks they've received because they have invited people through their link. That's something I'm not interested in whatsoever. But just to make very clear, do not try to copy my plays, okay? They'll probably lose. No, they won't lose. It's just that I'm going to be trading these instruments, at different times. And when I do talk about them, it'll be later down the line, maybe days or weeks after I've made those movements. So if you try and follow me, you won't be able to, pretty much. So I've picked 5 companies, and you can see them here. And we'll go through them. So the first one we have is AES Corporation. They are a utilities company in America. Now, it is very bad to say this, but with this strategy, you don't need to know the ins and outs. I don't need to know the ins and outs of the company, okay? They're a strong company. As you can see also on the income statement, the revenue's going up. So it's a growing company, and they're in profit. They haven't been in profit for these 3 months. I think there's a tiny slither of profit there. But what you've got to realise is, even when they were losing money, making a net loss in 21 and 22, the price was actually higher on average than it is now. So what I've looked at is just the last year. As you can see, it's higher. It's meant to be higher up. This company has been trading a lot higher, and now it's come down, and this has happened on a few occasions. It came down here, it rebounded, it came down here, it rebounded. If you look at the max, it's come down here, rebounded. It's not quant finance, okay? This isn't quant finance. But what I believe, and all this strategy is based off, is that with this company, the chance of it going up by 20% is a lot damn higher than going down 20%. I've come up with a 20% figure because 20% of 14 is about, 16, 17, about this range here. it's much more likely to get up here than go down to maybe 11 or 10. On my spreadsheet that I've done here, I bought it at a price of $13.88, and it's got 242 quid on it. I want to make it very clear, like whatever money I've put into this, I'm happy to lose. Okay, I'm not happy to lose it. If I lose it, it is what it is. I don't care. All of this is coming from my profits of my actual portfolio, so it is technically, I mean, it is money. Obviously, it's money, but I can afford to lose it. That's what I'm trying to get to. So I'm looking at, getting a increase up to $16.60, which is about a 20% increase around the mid-December range. So what I'm going to be doing is holding this company, seeing where it goes. Managers get up to 16, I'll be trading out in December. If it goes up a little bit, I'll probably be looking to trade out. If it's gone down, that's when I'll be looking at the time scale, thinking to myself, can I leave it a bit longer? But for me, I think this will be a pretty quick recovery. I think we'll get to 16 around mid-December. That's my goal. The next company is Coca-Cola. Coca-Cola is a bit of a lower risk play because Coca-Cola's fundamentals are absolutely incredible. Like, revenue has grown 4 years in a row. Net income is grown very marginally. I don't know why I'm looking at flipping charts because you can barely tell the difference. Here we go. So gross profit, as you can see, has come up. I mean, it did slump a little bit because it was quite high in 2016, but as you can see, it's growing pretty nicely. So yeah, revenue's gone up very well. It's a very strong company, Coca-Cola, as everyone knows that. Good product. It's obviously a consumer product, so it is in a different industry to AES Corporation. My goal is to I want a variety of markets to be invested in for this strategy, but I don't want to be in markets which are speculative. So things like utilities, energy, consumer, food processing, all those things, they're very well-known industries. I'm not going to be looking at anything in the AI sector. I'm not going to be looking at anything in the airline sector. My God, that's a bad one. Then again, I do like AES Corporation. They're a company that I think will fit this strategy very well. But Coca-Cola, just by the share price, and a lot of this is just based on the share price. As you can see, Coca-Cola, it got all the way up to $70, over $70, and then it's fallen all the way down to as low as 61.59. I got in at 63.30 with £275 stake, and this was just 2 days ago, and I'm already up on this one a percent. So that's a good start. So the range I'm going for on Coca-Cola is 10% and looking to exit mid-December. But Coca-Cola is a very stable one. And I just want to usher this point the most. This strategy isn't about, this company's going to go up 10%. I know it's going to happen. It's more about believing that I believe right now the chance of it going down to maybe 58 is considerably lower than it recovering back to 70, where it was before. They always say that past performance does not indicate the future performance. I think it does. Not one-to-one, but I think it means something that it was trading in the $70 range and now it's trading at 64. I think it pushes the idea that it will recover and come back. If you're wondering about these pending orders, what I've done is I bought the stocks. But what you can do once you bought the stocks is you can click sell. I think I'll have to delete it actually. So we'll delete it. So it's 69.63. So we'll close that. Well, pretty much this is all just queued up for if it does reach that price. So it was 69.63. But all you do is you set a limit and you set the minimum price you're willing to get for the share. You review the order and send the sell order. So what that means is if it does reach that price and I'm not looking at it, it will just execute the order. I'm happy to take 10% from that trade. And that's the way I look at Coca-Cola. So next we have Consolidated Edison, which is an energy company. Energy companies, I mean, this one fundamentally, again, is another consistent increase in net income. The PE ratio it's not the best, but it's low. That is low. Well, again, you look at the graph, and over the past year, look how many times it's gone down and come back up. Like, every single time it's come down, it's managed to come back up. Like, this looks like a solid graph here. We'll do ED. We'll have a little look on this graph. I like this graph more. But as you can see, I got in at 96.11. So I got in about there, right there. Again, I just believe it's very likely. I mean, look at that graph, bro. Look at that graph. That is almost the best graph you could have. Like, fair enough, in the last 5 years, it's not done that much, but every time it's gone down, it has recovered. But yeah, looking at this one, I wonder what I did for this one. Consolidated Edison, 10%, looking for a 10% profit, mid-December timeframe range. Bought it in at 96.11 a share, 268 quid on that. Again, I just think it's much more likely to go up to 160. Why have I wrote 160 there? 106. Fucking hell. 106.3. I don't know how that happened. But again, with this one, I think it's much more likely going to come up to here rather than go down to there. Okay, if it goes down there, and I do expect some of these stocks to make a loss, 100%, it goes down there. But I'd be looking, again, at this point, I'd be looking to exit, because if it's come all the way down here, there's obviously something going wrong. But as you can see, look how much, it hasn't moved that much. So that's a 10-year period there. It's gone up by about 7% a year, which is pretty awful. But look how much movement there's been within there. Next is General Mills, food processing. Again, look at the movement of this stock. Like, it's going up. Okay, we'll look at the fundamentals. Again, very strong on revenue. Net income is pretty consistent, but that isn't really too bad. Balance sheet, look at them assets. They aren't going anywhere. Liabilities aren't going anywhere. Low price to earning ratio. All of these stocks pay a good dividend as well, 3-4% dividends show that a company is strong, because a company will not pay dividends if it's struggling. It just won't happen unless they're trying to blindside everyone. But General Mills, I've gone for a 60, so I got it at $63.47. I'm going for a 10% profit of $69.50 a share, and that's going for mid-January. I'm going to give that a little bit longer, because that was in September where I did that. But as you can see, it's already rebound pretty well. This has happened, what, 3 times or 2 times here. So you could have bought it here. That's a solid 10% profit. You could have bought it here. Solid 10%, 15% profit. Could have bought it here. Same thing. There. Same thing. There. Same thing. There. Same thing. Like, there's lots of movement here where it's going up. And again, I want to usher this. It's all about probability. I am not saying 100% this is going to go up to $69 here, but I think it's awfully likely that it will go here rather than down there, like massively more likely. So that's the whole essence of the strategy. And last but not least is Hershey. Again, very well-known brand, Hershey is. They do chocolate, fantastic. And again, it's another solid company paying a solid dividend. Look at that revenue growth, nice revenue growth. Solid company. Again, we look at the graph. It's had this really weird tail fall off point. But as you can see over the last month, look how much movement there is here. I got in at $170 a share. I'm looking for 15%, 196, which it was very easily just a month and a half ago. So I think that will recover quite well. So those are my 5 positions at the moment. So as you can see, the current position is Coca-Cola. We're up 5 quid, up 2%. Consolidated Edison, we're up 2%. AES is my worst one so far. We're down 5%. But it is my most ambitious one, 20%. So I don't mind it too much going down. If it started going down by 10%, that's when I'd start looking at the position, really looking into the company, seeing if there's anything really going wrong. But I haven't seen anything. All these 5 companies, I've done the checks, and there isn't anything that's glaring to me. But with AES, there's a little bit of a decline. General Mills is up 3% and Hershey's up 2%. But overall, we're up, 13 to 7. We're up 12 quid so far, 12 quid, and that's about $1.5 grand. So yeah, it's less than 1%. But the thing is with this strategy is if you make, let's say you make 5% of stock, right? If you make 5% of stock and it takes you 2 months, that's a 2.5% a month return. 2.5% a month return is 30% a year. Like when you compare that to investing in the stock market, I mean, the S&P 500 returns 14% a year. So it is massively better than that. Like it's a really good thing. I'll show you some of the ones I'm having a look at shortlist wise. I've got Biogen. I don't know why I've actually put that one there. That looks like really weird price movement, that does. See, this company looks like it's just stagnating. Like, yeah, the revenue's coming down. So I'll remove that. I don't know why I even had that there. Excel Energy, as you can see, yeah, it's completely rebounded. But look at that movement. Look how many opportunities you have to get in. You could have got in there, there, there. You would have made a solid return there, there, and there. Like, there's lots of opportunities to come in. And I want to make it clear also with this series, it's very much like an animal, right? You're cooking an animal in the oven. There's going to be parts to it which aren't nice and you're not really interested in, but there's going to be other parts which are going to be really interesting and entertaining. And I hope that after I've done a few episodes of this, we're going to start seeing like what does well and what doesn't do well, and I can learn from it as well. I just find this really interesting. I won't go into Excel Energy at the moment because obviously it's too high. And also, I've got quite a bit in utilities and energy, and that as an industry isn't an industry I want to be completely hedging my bets on. We've got Northrop Grumman, nice name, again another dividend-paying company. Aerospace and defence. I've pretty much shortlisted these. I'm looking for companies where they haven't had incredible growth, but they've had a lot of price movement. That's what I'm looking for. So this one, there is a little bit of an opportunity arising. But for me, this industry, aerospace and defence, it's a bit of a dangerous industry to get into, I think. It's the same with like companies like Palantir, like they're doing amazing right now, but I just don't like the industry. There's just too much angst around it. Progressive is an insurance company, yeah. As you can see, look at this growth, like it is so solid. Right now, though, there isn't an entry point. I don't believe it's done so well, but you could have entered there, 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 there. But if it came down to like 220, 230, I'd be looking to get into Progressive. T-Mobile's 60% up this year. Oh, there's not even any point doing that one. It's going up too much. That's ridiculous. Procter & Gamble. It seems like every stock's doing well nowadays. My God, what growth that's had. Jesus Christ. Maybe if it was at 150, I'd look at that. I don't know. And then Air Lease, and I love Air Lease. Air Lease, I believe, is one of the best stocks for this strategy. Like the reason why I'm doing this strategy, whatever you want to call it, it's probably not even a strategy. It's just a way of shortlisting and picking stocks. But look at this company. Like, there's no movement. 2017, it's a company that's rich in infrastructure. Air Lease, they lease aircraft, would you believe it, to airlines. But they have such a security in all the assets they have. There is real security in that. Obviously, if airlines collapse, it isn't good. But Air Lease have massive deals, massive contracts with lots of airlines. But as you can see here, there's so many times you could have bought in. I mean, this is COVID, so that's ridiculous. But the amount of times it just goes down. Like, look at this. So in October 22, it was $33 a share. The next month, it was 38. So it's gone up by, my God, 25%. It's gone up by 25% in a month. And it does that like all the time. Air Lease is a big one I want to look at, 100%. But anyway, I'm going to end this video here. Thank you so much for watching. Hopefully you guys did enjoy it. I know it's a very different video. But I like finance. I find it really fascinating and interesting, and we'll see where my positions lie. I don't know when I'll do my next episode on this. We'll see what happens. I'll think of some talking points. But yeah, thank you for watching. Hope you guys enjoyed it. Smash the like button if you did, and I'll be seeing you guys later.